Hi everybody, welcome back to the BizTech Academy. Steve here, and today is the second in our series of 6 videos introducing you to options trading. In the first video, I walked you through the definition of an option and also introduced you to the notion of calls and puts, and we also used a couple of practical examples to show you how to use basic options. Today we're going to jump straight into option strategies and look at one of the easiest strategies that there is out there, and that's the covered call. Great for beginners and great for those looking to introduce options into their trading. Before I start, however, I must say as always that none of this is financial advice. I'm not a financial advisor, and everything I say today is purely my opinion. And of course, if you do like this video and you want to be alerted when the third video in this series comes out, then please give us a thumbs up and subscribe to the channel. Any support you can give us is greatly appreciated. Okay then, so the covered call. And as I said, this is one of the easiest strategies to understand, and it's great for beginners, great for those people wanting to introduce options into their trading and also be more active in their trading style. Although you can apply the covered call strategy to almost any type of financial asset, so for example, bonds, FX, even cryptocurrencies, in this particular video, we're going to look at it in the context of shares in a company. And in very simple terms, a covered call is a way for investors to generate income from stocks that they already own. So how does a covered call strategy work? Well, from conceptual standpoint, there are 4 key points you need to note when applying the covered call strategy. I'm going to run through these 4 points now, and then I'm going to give you a couple of examples, a couple of real examples of how you would apply covered calls in the real world. And the first point to note is that you need to own an asset. And again, this could be almost any type of financial assets, so bonds, cryptocurrencies, FX, and so on. But for the purpose of this video, we're going to look at company shares. And let's stick with a company we used in the first video in this series. And let's say we own 100 shares in Apple Inc. So we have our asset, which is great. And the next point to note is that we're going to sell a call option. Now, in the first video, when we were looking at calls and puts, from a call standpoint, we bought a call in Apple shares because we were expecting the shares to go up. And if the shares went above the strike price, then all things being equal, we would then be in profit. This time, however, we're going to sell a call. And the impact of this is that you agree to let someone else buy your stock if they want to at a specific price, the strike price, before a certain date, which is known as the expiration date. But don't worry, although we've now sold a call and given another party the right to sell your stock, this is done in return for a premium, i.e. money. And further, this is done at a price and a date of your choosing. So to reiterate, in this example, you have given someone, a third party, the option to buy your 100 shares in Apple at a certain price at a certain point in time if they want to. And in return for that, you collect a premium. But why would you do this? Why would you risk having to sell the shares you own in Apple? Well, the primary reason is income generation, but there's a little bit more to it than that. As said, when you sell the call, you receive a premium, you receive some money from the buyer, and that money is yours whatever happens, but you do risk having to sell the shares you own, 100 shares in Apple. And whether the risk is worth it depends on a number of factors. And generally, there are 3 scenarios where you would employ the cover call strategy and risk having to sell those shares. In the first scenario, you're doing nothing more than merely speculating on the price of Apple shares with the aim of earning an extra bit of cash through the receipt of the premium. And in this scenario, you're probably of the view that the Apple share price will either stay static or it will go down in value. You'll probably have some equity, or you're in the money with your current shares. So the current shares that you own in Apple, the 100 shares, you bought at a lower price than the current market price. And therefore, if you do sell them, you won't lose money anyway. And you'll also choose a high strike price. So the likelihood of the share price getting above that strike price and the option being exercised, i.e. you have to sell those shares, is limited. Now, it is worth noting at this juncture that although you are employing a low-risk covered call strategy, you're choosing a high strike price, and you also expect the shares to either stay static or go down and therefore not reach the strike price. There is a risk that doesn't happen. There is a risk that you get it wrong and the strike price is met and the share price goes above that strike price. If this does occur, and I'll run through this in the examples in a short while, then there is a risk that the third party exercises the option and buys your shares. And if that occurs, yes, you'll keep the premium. And yes, of course, you'll get the proceeds from the sale of the shares, but you will no longer own those Apple shares. Okay, the second scenario when you may use a covered call strategy is when your shares are in the money and they're at your target price. So you're happy with the investment, it's got to where you want it to get to, and you want to sell those shares, or you maybe just want to profit take and sell some of those shares. If this is the case with you, if you do have some shares that have met a target price and you want to sell them, you can use a cover call strategy to generate a little bit more income whilst you're going through that selling process. In this scenario, you'd probably use a strike price quite close to the current market price and also use an expiry date for the option quite close in. If the strike price is close to the market price and it's a short dated option, then the premium for that particular option is likely to be higher than the other way around. The third scenario is where your Apple shares are out of the money, they're at a loss, and you don't anticipate the share price going up in any which way in the near future, and you simply want to cut your losses and try and mitigate that loss as much as possible. Similar to the previous scenario where you're trying to sell your shares that are in profit, in this scenario you would just choose a strike price close to the current market price and also a short window for the expiry time because you're trying to generate as much a premium as possible. But note that in this scenario, you'll get nowhere near to generating enough premium to cover your losses. That is highly unlikely, but any contribution to that lot, of course, is welcomed. Okay, so I've looked at the covered call strategy at a conceptual level. I'm now going to use some hypothetical examples of how this can be applied in the real world, and this should then clear up any concerns or any confusion you still have. Firstly, let's consider the example where the Apple share price rises above the strike price and within the expiry period of the covered call. So you can see here that we have prices for selling 4-month expiry options for Apple at certain strike prices. We also have our 100 Apple shares that we bought at $140 per share. We then have our graph and we can see that at month 0, Apple's share price was $155. We think that the share price will rise over $200 in the next 4 months, but we also do want to sell the shares and take our profit, so we'll sell a call at a strike price of $180. Remembering we bought the shares at $140, so we'll make $40 per share if we do sell at that $180. On the table on the left, there are the call sell prices, and we can see that the sell price at the strike price of $180 is $12. You'll remember from our first tutorial that this price is the price per share, and for US stock, and of course Apple is a US stock, an option equals 100 shares. So in this instance, we have 100 shares in Apple, so we will sell one call for $1,200, i.e. 100 times $12. And this premium, less any transaction or brokerage fees, is ours whatever happens. Over the next 4 months, the Apple share price does climb above the $200 mark and actually surpasses $180 in month 3. And at this point, the purchaser of the option decided to sell the option and purchase the shares from you at $180 per share, the strike price. This provides you with a profit on the shares of $4,000 and a total gross profit of $5,200. From this, you would need to deduct the transaction and brokerage fees, let's say $50, and this leaves a net profit of $5,150. Good stuff, but it's also important to remember that you also missed the opportunity to sell the Apple shares at $205 per share if you'd have not followed the cover call strategy and just waited for 4 months. And at $205, the profit per share is $65, so $6,500 in profit. Now, if you ignore brokerage and transaction fees, that means we missed out on $1,300 on profit if we'd have just waited and not gone down the covered call route. But then again, we didn't know the share price was going to go up to $205. In the second example, I'm going to assume that the market price of the Apple shares does not go above the strike price at any time within the 4 months of the covered call option. Again, as you can see here, we have our 100 Apple shares that we bought at $140 per share, with a share price in this scenario at $155 at the start of month 0. The option expires in 4 months and we choose the same strike price of $180. We sell our single call at $12 and therefore collect an immediate gross premium of $1,200. The share price follows the same path as the previous example for months 1 and 2, but in months 3 and 4 it stays flat and closes at the end of month 4 at $160. In this case, the option is not exercised by the purchaser of the option and they let it expire. And in this scenario, your profit on the shares is 0 because you still own the shares. Your gross profit, therefore, is the $1,200 premium you collected from the covered call, less any brokerage and transaction fees, and let's say $50, and therefore your net profit is $1,050. Okay, that's almost it. That's the cover call strategy explained in its simplest form. If you're still confused or if you have any questions, please add them to the comments below and I'll certainly try and help out as much as I can. In the meantime, though, if you did like the video, please give it a thumbs up and subscribe to the channel. And as always, thanks ever so much for watching, and I'll see you in the next one. Bye-bye.